Hey, I'm Ben from Modern Graham, and today we are going to talk about FedEx Corp. So be sure to stick around to hear what I think of this company. So today we have FedEx Corp. The ticker is FDX. The current price is 173.18, and the sector is industrials, with the industry transportation. Of course, I think everybody watching this probably knows what FedEx does. They help move goods. And of course, that is why they're in transportation. But anyway, the items from the balance sheet that I view as most important are over here: the total current assets, total current liabilities, long term debt, total assets, intangible assets, total liabilities, and outstanding shares. All of those numbers, all of those figures will come into play in the valuation. Over here, we have our chart showing the earnings per share in blue and the dividends per share in red. And you can see that for the most part, FedEx has done a good job. It has had a few times when earnings really dropped off a cliff, but it tends to recover pretty well. And that is very good. And it's especially interesting that the last few years they've had outstanding earnings. Looking here at the detail, you can see the detail in those earnings. They have been rising, and then they hit some peaks there before they hit a crash, and then they're back up again. Earnings per share, Modern Graham, is a weighted average, or EPS MG. It's a weighted average of the last 5 years of earnings, putting the most weight on the current year and the least weight 5 years ago. And that helps to smooth out the business cycle a bit so that you can see trends in earnings overall. And as a whole, it has been on the rise. So that is good to see. Dividends per share, you can see the detail over here. It has paid a dividend for, 20 straight years, which is really good. Once it started paying the dividend, it hasn't stopped. And dividend growth, you can see that most years it has grown the dividend, but it is not really dedicated to growing that dividend. In the years where it has had some earnings issues, it has, well, actually here it had, right here, 2019, earnings dropped, but it still ended up raising the dividend. But then, yeah, for a couple of years, it kind of held steady there. But over here, you can see the yield has stayed between, really under 1% most of the time, under 2% all the time. But then the dividend yield payout, or the dividend payout ratio over here, you can see that they don't pay out a lot of their earnings. They're reinvesting a lot of those earnings. Stage 1 in the analysis is to determine if the company is suitable for the defensive investor or the enterprising investor. The defensive investor is somebody who's not willing to go to a lot of extra research into a company. They want to have a high bar to look at. And so they have these 7 tests that companies have to pass in order to be suitable for the defensive investor. First, we have the market cap has to be over $2 billion. FedEx passes that. Current ratio has to be over 2. Here it is only 1.42, so it does not pass that. Positive earnings per share for 10 straight years. We pass that. Dividends for 10 straight years. It passes that. Earnings growth over 10-year period. It passes that. Moderate price to earnings ratio. It passes that too. It has to be under 20, and here it is 12.97. The PB ratio has to be under 2.5. Here it is 1.79. And if you have been keeping count, we are at 6 out of the 7, and that is a passing grade. So it is suitable for the defensive investor. And the enterprising investor is somebody who's willing to do more research. And even though here the FedEx does not pass enough for the enterprising investor, because it passes the more the harder tests of the defensive investor, it passes for the enterprising investor by default. Moving on, be sure to take a moment to like the video and subscribe to the channel if you're enjoying the content. And when the video is over, click on the link down below to get a free valuation calculator that you can use in your own research. Stage 2 is to determine the intrinsic value. And remember that the value is independent of what the market is currently paying for it, or willing to pay for the company, the price. So to calculate the value, we take Benjamin Graham's formula from The Intelligent Investor, and we take which is value equals earnings per share times 8.5 plus 2 times the growth rate. I've put in the weighted average earnings per share, and so I call it the modern Graham value formula. So we have two variables to calculate here with earnings per share and the growth. So looking at the earnings per share, again, it's a 5-year weighted average. We get the earnings per share modern Graham to be $13.35. For growth, we take that figure and we take the figure from 5 years ago of 848. We calculate the total growth over the period of 57.44%. Divide that by 5, we get an average growth rate of 11.49% per year. And then we have a safety margin, and it's important to have a safety margin here because the growth rate is a key variable in the formula, and overestimating growth can have a huge impact on your value estimate. So here we have the growth estimate limited to 8.62%. Plugging those figures into the formula, we get a value of $343.53. And of course, with this handy chart, you can see that that indicates the company is undervalued because that value is much higher than the current price. A few other things of note. One, the value based on a 3% growth rate would be $193.58, which is still higher than the current price. Based on a 0% growth rate, you would have a value of $113.48. And if you put price in for value and then solve for growth, you can see that the market is implying a growth rate of 2.25%. So if you believe the company will grow higher than that in perpetuity, then it would be another indicator that the company might be undervalued. Looking at the modern Graham grade, which is a thing I've developed that can help you compare one company to another from perhaps a different industry or just looking at your different opportunities. It's another way of looking at companies. We have 2 points for being suitable for the defensive investor, 1 point for being undervalued, 1 point for trading below its Graham number, 0 points for long-term dividend growth, half a point for being a dividend yield above 2% right now, half a point for trading below its industry average PEMG, and for a total score of 5, that results in an A grade. Stage 3, if you've gotten to this point, if you decided that the company is suitable for your individual investor type and it is undervalued, which is what we just went through in stage 2, then you would be looking at it and deciding whether or not it is suitable for your individual portfolio, taking into consideration things like your diversification in your portfolio and your individual goals. So you would want to look at things like the Graham number formula. And here you have a formula that has been derived from the defensive investor requirements to give you another number that you can compare to price. And here it is pretty comparable to the price. So that may indicate that it's fairly valued. It definitely does not indicate that it's overvalued. And so it may be another confirmation for you. Or it maybe isn't high enough. And so maybe in your threshold, it's not good enough. I don't know. But that is the Graham number there, 177.84. The PEMG formula, we get the price to earnings ratio. With the weighted average of earnings, we come to 12.97. The current ratio is 1.42. The PB ratio is 1.79. The current dividend yield is 2.2%, and it only has 1 year of dividend growth. Stage 4 is to look at the chart and determine whether or not it is a good buying time, because once you have determined that it's good for your portfolio, you still need to try to maximize your profits. And here we have an interesting chart. If we go back to the weekly view, you can see it's been on a downward trend since 21, and it's been coming down. And I've got these two trend lines here, which the company has, like the price has kind of followed it, especially over here. It came back up and didn't quite pass that. And then on the downside, the trend, it broke down through there, and then it came back up. These are not very good trend lines to like really use. They don't have a lot of points where the price is really confirmed to them. So don't put too much weight into them. They are interesting to note that here it kind of is above that, and now it's kind of testing that. I don't know how much that will continue. But what I do know is that we have these support and resistance lines that have developed here. And if we go back to the daily view, you can see another interesting thing. So like down here, it created this line here. You could probably say that there's another one here. And then up here, it hit this one here, which I think had been from before. And it's kind of staying in there. But what I find most interesting is this gap here. So you can see the price was up there. Then the earnings came. It missed the earnings, which is why this is red. You can see it surprised the earner, like the surprise was negative. So it had a big drop there. But the market always loves to fill a gap. And so I would expect that the market will try to be pushing it up. And you can see that's kind of what's happening here, where it dropped a ton. And you can see this is the RSI, the Relative Strength Index, which shows momentum. And that came down. It was already on the downward side, and then it missed its earnings, and so it dropped, and it went way oversold. That is a very low RSI there. And then the market started to come back up, and you can see the momentum has been building on its way back up, but now it seems to have stalled. And part of that is because it got up here to 70. And if it crossed over 70, it would mean that it was entering what could be considered a bullish pattern. And it has not been in a bullish pattern since way back here. And it was very temporary, November of 21, where it was in that bullish pattern, and then it really confirmed the bearish pattern down here in February, and it continued in that bearish pattern where it has not crossed over 70. And I think this is the market indicating that it is still in a bearish pattern. It has not made the turn yet. I would be very interested in watching whether or not it comes back down or if it fills that gap, and then watching it from there. So I think this one would be one to add to a watch list and keep in mind and kind of pay attention to, but it might not necessarily be the most profitable time to enter. So I don't know. You can make that decision yourself. But anyway, if you've enjoyed my analysis, be sure to click on the video on the screen now to see more from me. Thanks for watching, and I will catch you next time. Take care.